you have 5% nominal GDP in a world where you have a 1% 10-year Treasury note. And the only buyer, the really indiscriminate $120 billion a month buyer of mortgage-backed securities and treasuries, so they're doing 80 billion of treasuries a month, 40 of mortgage-backed securities. When that buyer steps away, you have the potential of a slingshot higher in yields temporarily. That'll crash the stock market. Then everything will, implode on itself, and the yields will start heading back down. I don't want to be a part of that.
This is Donnegan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver dealer with Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized, private service from one of the oldest and best respected companies in the business. 30 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded, insured delivery or vault storage or IRAs, excellent prices, privacy and confidentiality, pay by check, money order, ACH or wire, satisfaction guaranteed. Call me directly at 419-819-9209 or my associate at 310-562-6400 or email us at kaiser@milesfranklin.com. Welcome back to Liberty and Finance. We have a returning guest. Michael Pento is the founder of Pento Portfolio Strategies. He's an active money manager, and he helps many of our clients with managing their portfolios. He joins us again this Friday, January 15th, 2021. Michael, thanks for coming back on.
Always a pleasure to be with you, Donnegan.
I'm still saying the 2021 wrong. I'll probably be doing that till February. But anyway.
The years are going by quick, very, very fast.
It is. So before we jump into some viewers' questions, and we have several of them that have been submitted ahead of your arrival here, we wanted to give you a chance to give us the things you're most concerned about or the things you got your attention focused on the most for 2021 as you're taking care of money of lots of folks.
So, there's so many issues and cross currents lately. But let's see, some of the most salient things on my radar are how effective are these vaccines going to be against these new variant strains of COVID-19? So that's first and foremost. Also, you're hearing now that there's some delays in the production of vaccines. There's some bottlenecks in the distribution of vaccines, and so much of the rebound in 2021 is predicated on these, the distribution and efficacy of these vaccines. So that's number one. But number two, and a little more predictable, what I'm worried about more than anything is that the central bank is going to lose control of our bond market yields later in the second half of 2021. So we have a confluence of some factors where we have almost $28 trillion national debt. We have almost $80 trillion in total debt, public and private, in the United States. We've got debt and deficits running at 15 to 20% of GDP, just absolutely nightmare proportions. It was $4 trillion in spending last year, year over year in January 20 to January of 2021. We now have the Biden administration coming in proposing, before he's even in office one day, almost $2 trillion, $1.9 trillion in spending. So you have banana republic-like debt and deficits in this country, and they're going to run smack dab into a Federal Reserve that has promised to create 2% on the core PCE rate of inflation for at least a year before they do anything about it. So you're going to have all this debt, meet all of this inflation, and then you're going to have the Fed pull back on their QE. Probably, I'm thinking close to the end. I'm saying about summer, second half of 2021, I'll be looking out for the Fed to make some kind of statements that, hey, inflation is running very hot. We're not going to taper yet. We're not going to raise rates yet, but it's coming up. They'll throw that warning to Wall Street. So what do you get when you have 5% nominal GDP? You have inflation and growth. So inflation will be 2, maybe 2.5%, the way they measure it on the core PCE. Then you have 2.5% real growth. So you have 5% nominal GDP in a world where you have a 1% 10-year Treasury note. And the only buyer, the really indiscriminate $120 billion a month buyer of mortgage-backed securities and treasuries, so they're doing 80 billion of treasuries a month, 40 of mortgage-backed securities. When that buyer steps away, you have the potential of a slingshot higher in yields temporarily. That'll crash the stock market. Then everything will, implode on itself, and the yields will start heading back down. I don't want to be a part of that. We've had a very good year in 2020. Thank God, we had a wonderful year. We haven't lost money in the portfolio for a while here. And what I'd really like to do is protect, and preserve those profits for my clients. And then I would like to jump on the other side. I'd like to profit from this very healthy. By the way, short sellers aren't evil. Time again, they prevent people from perpetually top ticking bubbles. So it's a very healthy reconciliation, probably coming in the second half of 2021. And I'd like that to benefit my clients if I can.
I think you just covered this topic, but we'll just see if there's anything else you want to add on this. Hybrid Part says, will the bond market go out of control this year? You talked about this potential inflection point if the Fed steps away from buying the bond.
Yeah, I mean, it has the potential to slingshot up maybe 250 basis points in a matter of a few weeks. I think that is losing control of the bond market. That's a risk out there. I'm not saying it's going to happen. It's something I'm going to monitor very, very closely. The chances of that occurring are very elevated. If that happens, it'll crash. It'll absolutely crater the stock market. I'm going to try to get ahead of that if I can, using my inflation, deflation, and economic cycle model. So yeah, I'm not predicting it, I'm not guaranteeing it, but the chances are elevated for that to occur this year. It's not going to be the ultimate crisis coming. The ultimate crisis coming is when you're going to see yields shoot up to double digits. That's going to be an inflationary and insolvency crash in bond prices and yields soaring. That's not going to happen. I don't think that's going to happen this year. But we're going to gradually, we're through these various iterations of boom bust cycles, we're building up to that. I watched some of your programs, Dunnigan, and there's such a misconception of what inflation is, even from some very, prominent people out there. Inflation, yes, of course, the technical definition of inflation is an increase in the money supply, but we have had massive inflation. I'm not going to call out the name of the guest that you had, but someone I respect greatly. But we have had massive inflation in asset prices. I don't know why people don't calculate asset prices. If you create, Fed's balance sheet now is almost $7.4 trillion. It was $800 billion in 2007, the end of 2007. So it's $7.35 trillion. That money did create inflation, but where did it go? Dunnigan? It went to home prices. It went to bond prices. It went to equity prices. That's where your inflation is. And if you want to get inflation in the broader sense of the word, going out to consumers, consumer price inflation, you will have the central bank directly monetizing treasury debt. That's how you get that function to appear. That's how it becomes manifest. So we're seeing that in the striving towards universal basic income. Okay, if you have a treasury that guarantees a certain amount of income through checks to people who they consider indigent, which apparently is anybody who makes less than $100,000 a year, you give them these checks regularly. Those checks are then monetized by the Federal Reserve. You will get not just inflation in asset prices, you will get a spiking consumer price inflation, because the broader money supply aggregates will be booming in that case. So it won't be just base money supply, which is what the Federal Reserve directly controls. It'll be M2, and they used to, M3 don't calculate anymore, but it'll be M1, M2, and M3.
You mentioned briefly earlier a $2 trillion budget proposed by Joe Biden, and you just touched on here the huge spike, $4 trillion or so up to $7 trillion now balance in the last year here on the Fed's balance sheet. The question from Mr. Diamond 217 says, can the American financial system survive a Joe Biden presidency?
Well,
so what are the elements at play there?
It's going to be kind of like the same answer. So what happens to the dollar, and more importantly, what happens to the bond market when you have these stresses? I mean, you look at $80 trillion of public and private debt. If you look at the deficit for the first 3 months of fiscal 2021. It's up 60% since the horrific numbers that were evident in 2020. So you have almost $600 billion deficit in 3 months, Dunnigan. So it's a great question. Can the stock market, can the bond market survive a Biden administration? Well, I believe it took 200 years for the United States government to run up $1 trillion in debt. Well, under Donald Trump, a Republican, ostensibly, we ran up $4 trillion. We had a $3.5 trillion deficit in 1 year. And Joe Biden comes in and he spends like all Democrats like to spend, which is even worse than Republicans. Republicans are fiscal conservatives until they become in charge of the economy. Then all of a sudden they said, listen, we need to spend a lot of money because the stock market's a bubble and we can't have that crash. So we need constant fiscal and monetary heroin. So then Biden comes in, and it's not in his year. So Trump spent $3.5 trillion deficit in a year. Biden, in negative 7 days before he takes office, has promised to spend $1.9 trillion. So, can it survive? I have my doubts in the second half. I'm looking at the May to September timeframe, May, June to September timeframe, where my model is forecasting that the culmination of inflation, the second derivative of inflation growth, combined with the amount of debt issuance, combined with the Fed starting to make rumors about pulling back on QE, that could send the bond market soaring, and that would cause absolute mayhem and chaos in the stock market. And the question is, probably not. Probably not. We're probably going to have by the way, if you remember, we've had crises in the last 4 years as well in the bond market. You remember what happened in 2018, the fall of 2018, 2019. So you've had the repo market freeze up. So you've had these crises before. You're going to have them more frequently and with greater intensity in the coming 4 years. That's my prediction.
Down the line still of how administrations and their vision of the proper relationship as they see it between government, industry or business, I'll say corporations, and the individuals shape our future reality. People are very concerned right now that they don't know what their country is going to be like a week, a month, a year from now. Special K says, in December, the World Economic Forum launched a new initiative called the Davos Manifesto. It posed the question, what kind of capitalism do we, the elites, want moving forward? Will it be the China model where you and I own nothing and your whole life will be watched and heard on big tech devices? So the model of the relationship between big government, big business, and the individual, what do you see perhaps most probable in your view, and what is the financial impact on ordinary people of what the progression that you see as the most probable? Maybe that's what you've already laid out.
Well, I'm not quite sure I completely understand the question, but what I'm worried about occurring is the yawning gap between the rich and the poor in the next 4 years. I mean, you thought it was bad, under the last previous administration. It's going to get much worse because what the Fed most cares about, they say. Originally, by the way, the Fed didn't care about anything but rescuing banks that were in dire straits. But now they've morphed into an institution that can cure racism, can cure pandemics, can make sure the stock market never has a downtick. So, but what they're doing is they're fomenting a lot of bifurcation in the economy. So you're telling people because of the pandemic that they're under lockdown, that they can't go out and engage in the leisure and hospitality sector of the economy. And these people, by the way, don't tend to own a lot of assets. They don't tend to own a lot of houses. They don't tend to own a lot of equities or bonds. So their jobs have been taken from them, and their assets that they don't own, obviously, who cares if they're in a bubble? So they get further and further behind the higher, the top quintile of residents in the United States, as they benefit from rising equity prices, rising bond prices, rising real estate prices, and they're mostly white collar workers. So, their jobs are fine. They can work from home. They can do Zoom meetings. They can do Zoom interviews. And they benefit from, like I said, from all these bubbles. So that's my concern. We have a growing, my opinion, a growing racial divide in this country, unfortunately, and a growing divide economically speaking, morally speaking, economically speaking. So that's my biggest concern. I'm not sure if I answered that question the way the person posed it exactly, but that's what I see headed in the next 4 years.
Yeah. What I take from their question was that in the economic paradigm where individuals, ordinary people, don't typically own property, but just depend on either government assistance or universal basic income or whatever to get by. How does that world, if that's what we're heading toward, how does that affect people's lives, their ability to insure against economic impacts on their families, they take care of themselves in case they have a rainy day or whatever?
It's a disaster morally speaking. I mean, certainly in the Bible, I mean, you should have to work to eat. I mean, you're telling people they can lay fallow, collect a check from the government, which is going to be printed by the central bank. There's no increase in productivity whatsoever in that function. So the value of the currency goes down against hard assets. These people that are receiving this check spend a much greater percentage of their income on the basics, food, clothing, shelter, than the rich people do. And they're going to fall further and further behind as the country loses its moral core. So that's a problem.
Yeah, I know that in addition to the moral implications there's also when there's a spiritual implication and a moral implication, there's often a physical manifestation of that. That's also can lead to depression and all kinds of other outlets where people don't feel a sense of purpose, that sense of being needed, and we're made to have that drive.
Correct, and we're not being insensitive. I know people that are told that they can't go to work deserve some kind of a recompense. But we're not headed that way. We're headed for a condition where people can say, I can stay home and collect a check rather than be productive.
Yeah. How about
that's not where you want to go as a country.
And how about when workers are being told by policy that they shall not go to work and they can't earn their normal wage, but they still have to pay the taxes, or the property tax for one, and also that the people who are making those decisions are still collecting their checks because government is essential or whatever. Maybe we should have government people take the first layoff before anybody else. Question for you on your economic model from Kruno says, gold, 10-year yield, and inflation are all correlated to each other one way or another, but which one moves first and which one moves last? Where do you see all of those in several years? Can you talk about, because you often talk about your model, can you talk about what you pay attention to in terms of gold, 10-year bond yield, and inflation?
So this I've talked about this for years now, and it's borne out to be true. Gold doesn't really care as much about the direction of the dollar or what your trade deficit is or any kind of conflagration overseas. Gold cares about the direction of real interest rates. That is what its primarily function is for its price. What is the direction of real interest rates? So if you look at where bond yields were earlier in 2020, in the summer of 2020, they hit the nadir of 0.5% on the benchmark treasury. So I knew, based upon the projected trend in the virus and the vaccines, that Wall Street, the deep state of Wall Street, would come up with the narrative that 2021 would be a return to normalcy. Now, believe me, the market was anything but, and the economy was anything but normal prior to the start of the breakout of the virus. But when you have nominal GDP returning somewhere in the neighborhood of 5%, and your nominal yield starts out at 0.5% on the 10-year note, I knew at least, that there was plenty of room for nominal yields to rise much faster than the rate of inflation, ahead of it and much faster than it. And that's exactly what's happening. It's probably going to happen all the way through to the second quarter, third quarter of 2021 this year. And so what you had is a slingshot effect. So, we had the piling into the treasury, bond prices being bought, okay, yields coming down, and that hit 0.5% in the summer of 2020. It then doubled. That yield doubled. Now, the rate of inflation did not double between August of 2020 and today. It did not double. So what happened is you had real yields rising, which is kryptonite for gold. And as I said, that's a temporary condition. Since I actively manage money, I avoided it. I sold all of my miners. I only hold 5% position of physical gold in the portfolio. You see, even in a day like today, we're on the recording of this interview, yields are falling because of some really bad numbers on retail sales. And we even had some horrific numbers on initial jobless claims. We're still losing a year after the breakout of the pandemic. We're still losing 1 year after the initial breakout of the pandemic, 1 million jobs per week. That's incredible. So you're having a lot of bad news, which forced yields lower, which should be good for gold, but it's not. See the way the algorithms are reading this. They're saying it doesn't matter what happens in the short term. We are headed towards a condition of normalcy, a return to normal yields. If you look back, Bloomberg did a study on this. So from the early 60s to the year 2000, the average yield on the 10-year note was above 7%, 7.3%. So we're not going there, but we're going higher. We're going higher faster than the rate of inflation, at least until the middle of this year, which again, that is pushing down gold. But that's going to end soon. I think yields top out by the third quarter of this year, and then they plunge along with the stock market. So yields will be going down, bond prices surging, and gold will have a wonderful, wonderful end of this year. So if you want to get it while it's on sale, you can get it now. But as a money manager, an active manager, what I do is I toggle the percentage of physical gold and miners in the portfolio. And so I took advantage of, I think I sold most of my gold exposure, I believe it was September, October of 2020. Don't quote me on that. But we months ago, we sold our miners and we went to a 5% position. After being 25% long for most of 2020, we were about as bullish as we get in the portfolio on gold. But then once the vaccine started, I called it the vaccine dead zone. That's exactly what happened. And it's still happening today.
Related question here from Peter Mangano, who says, what is the single biggest thing that the gold pitch people have failed to understand?
Well, I think what they do is they tend to look out and say, 5 years from now, gold should be $6,000 an ounce, $10,000 an ounce. I think you had a gentleman on your program said it was going to be, what did Mr. Rickard say?
$15,000.
$15,000 an ounce. Excellent, very smart man. That's probably correct. That's probably where it's going. If you look at, I think he used M2 money supply or M1 divided by the ounces of gold. That's probably where it's going, but that doesn't do anybody any good if they want to make money in gold. I don't invest that way. In 2012, you could have said, well, gold is eventually going back up to $2,000 an ounce. But, that doesn't help you. You had many years where miners and gold did not do anything for you. Mm-hmm. So what I'm saying, listen, everybody should start with 5% of their net worth in physical gold. That's where you should start, and just keep it. Don't trade it. Don't worry about it. Make it a legacy heirloom for your kids.
Yeah, I think the reason that makes sense, what you're now saying, is not because gold does nothing for you. It was doing nothing for you during that decade in terms of nominal gains, true, but it was providing a different function, which is why you have the 5% that you're talking about.
Correct. Correct. And then you use that, you build off that base during times when nominal yields are falling, when real yields are crashing. You can vastly increase that physical exposure, and even more important, by the gold miners, which, by the way, have beautiful balance sheets now. They're really cleaned up their act. So I'm thinking that gold and miners will have a wonderful end of 2021. So we'll look forward to that. But it's just not the time to do it right now. I mean, I'm an active manager. I try to maximize the return to for my investors all the time. But if you just want to just say, listen, this is for my grandkids, I don't care, then, start with your 5%, add to it when you can, when it's on sale.
Related question from Kruno about your model and performance. Can you please talk about your fund for a bit? What is the minimum dollar entry amount? How did it perform in 2020? What is your fund's strategy and allocation?
Okay. So we had a wonderful year in 2020. I think I'll be uncomfortable quoting exact returns. I can send you, we have a third-party firm that tracks our monthly returns called SMARTX. But I think, I'm not supposed to just pick one year. So we had a wonderful year last year. We just did much better than the S&P 500. Doesn't happen every year. But we need 100,000, around 100,000 minimum. That is a little bit flexible. But if you want to reach out to me, it's, the website is, we'll probably do it at the close of the show anyway, but the website is pentoport.com, and you'll see a podcast there, and you'll see some great research also, and an ability to put your money with the IDEC model, inflation cycle model. And
there you go, your fund strategy and allocation, yeah.
So it's the way I manage money is predicated on the second derivative of growth and inflation. And I wrote a book about this basically in 2012. I talked about it actually on CNBC in 2008 when I was invited on there twice a week. Actually, all the way back to 2007. I said, listen, we live in an economy now where we're either inflating or deflating. It's very unstable. There's no more periods of very stable growth and stable inflation because the whole construct is artificial. It's predicated on borrowing more and more money that is printed by the Federal Reserve. So you can't have any monetary conditions of stability any longer. It's just these boom bust cycles because you need more and more heroin to make the addict high. You addict the economy to this juice of fiscal stimulus, and you'll see what happened. Look at the retail sales. I mentioned them today. They were a disaster. Why? Because the $3 trillion that we borrowed in March and printed in March wore off towards the end of the year. That's the primary reason. Okay, the virus was bad. Virus was bad throughout all of 2020. We had a spike towards the end of the year, but that's not the real reason why jobless and retail sales crashed. The real reason is that people stopped consuming because they didn't have the money any longer. They already spent it. Because don't look at gross savings, because savings is an aggregate number. Savings of the very wealthy are piling up. But if you're in the lower quintile of this population, you don't have any savings at all. You didn't have it before this pandemic broke out, and you have even less now. So that's the function going on in the economy.
And back to the strategy and allocation of your fund.
So I look at the second derivative of growth and inflation. And when growth is accelerating and inflation accelerating, we buy certain style factors in the portfolio, certain ETFs. So you want to have high volatility, high growth exposure during times of inflation and growth. Times of decelerating inflation, disinflation, you want to allocate more towards bonds, low volatility sectors. In that function, you could always be invested no matter what the cycle is. So you can ride bubbles higher when things are expanding. You can own the right sectors and style factors when we are in a recession. And most importantly, because the way the model is constructed, you can protect and profit from big drawdowns in the stock market caused by recessions and depressions and deflations. So we look to not only get out of the market in that condition, but also short the market when that particular cycle becomes manifest. So we predict it, try to profit from it, and that's what we do here. So that's the most important thing. If you can have a robust model, I have a 20-point model, 10 components for inflation, deflation, 10 for growth and recession. If you know what the economy is doing in the second derivative sense in growth and inflation, you'll know where to invest at all times. And the most important part is you're able to protect and profit during cyclical or secular bear markets.
And I wanted to make thank you. I wanted to make a point for people who want to make sure that they stay in touch with us is to please go to libertyandfinance.com. Over on the left-hand side, put in your name and email address. We'll get you on our free email list. Make sure you get 3 updates a week, which will include all of Michael's interviews, all of our guests, all of the descriptions and any links that they provide so that you can stay connected with us. And unfortunately, should our fate be like several dozen of our compatriot independent media sites who got deplatformed, you'll know where to find us. One tip is you'll see us on Brighteon and Rumble. We have been having plenty of delays and difficulty with uploads to Brighteon because basically you've got basically half of the ideological world trying to crowd into that narrow space right now, and I think their servers are pretty much overwhelmed. But we were successful at getting some of our recent interviews up on Rumble. So I'll put the links to those in the description of this video. And Michael, again, give people a chance to know how to get a hold of you.
Okay, so the office number here is 732-772-9500. You can email me directly at mpento@pentoport.com, and the website is pentoport.com.
Thank you, Mike. We've been speaking with Michael Pento. He's the founder of Pento Portfolios, and been here with us again on Liberty and Finance. And just thank you for joining us, Michael.
Always a pleasure, Dunnigan.
If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today. To acquire gold and silver, just go to libertyandfinance.com. When the main site comes up, click on Bullion Sales. That's libertyandfinance.com, Bullion Sales. You'll see my name, Dunnigan Kaiser, my phone number, and my associate, Kaiser Johnson, his phone number, our email, libertyandfinance@protonmail.com.